Hey, everybody. It is Chuck Barone on Thursday, July the 11th, 2024, CPI day. And boy, did the Fed get what they're calling great news. Jobs report comes in soft. All kind of data for the Fed today, looking like things are going the way they want them to. So the markets, the funny thing is, we've had the markets going higher on the anticipation of a Fed rate cut, right? And today we get news that probably leads to a Fed rate cut and the markets tank. I was telling you guys, right? Buy the rumor, sell the news. That's kind of, I think, what we're seeing in these markets today. A weird day, right? The bond market rallies up like crazy. Stock market, not so much. Anyway, before I get rolling, let me take a half a second. Welcome everybody to the show. As always, thank you guys for your support. It means the world to me. Nice to see all my friends on the chat going. The usual suspects: Big Smoke, Big Salty. We got Attila on there. We got Elevate, my boy Tommy, Paradiddle, all the way from Australia. Lots of good people. The regulars, Ghazi on today. Nice to see everybody on that chat. Keep it rolling, guys. And let's talk about these markets today. So we got the CPI report. Numbers came in very favorable, even better than they anticipated. The top line inflation falls to 3%. Actually, inflation actually fell. Prices, actually fell 0.1% last month. Pretty impressive. I got to see, though, because I'm just not seeing signs of prices coming down anywhere. I guess maybe you can say, prices aren't going up so much. Okay, I can see that maybe. But prices coming down? No. Hey, Kevin, how you doing, bud? Crazy times, guys. Crazy ass times. Jobs fall. The job number comes in 17,000 less than what they expected. So everything went the Fed's way today. So here's how the markets played it. The Dow Jones was up 32 points. 39,753 on the Dow. The NASDAQ falls 364 points, 18,283, and the S&P falls 49 points, 18,283. That can't be right. That's the NASDAQ number. Anyway, S&P also down, was around 5,400. So anyway, the amazing thing is the NASDAQ and the S&P had been setting records on, for their numbers. And today, the day they really, you would think would be the day they'd be celebrating. No, a sell-off. I don't know, guys. What do you think? You think 3% inflation is enough to make the Fed cut rates? Because once they start cutting rates, obviously that's inflationary. You think inflation numbers will continue to come down once they start cutting rates? I got to say, I have my doubts here, guys. But the market reacting like we're already at or below 2%, it's nutsoville. So the stock market today, I mentioned it yesterday on the show, buy the rumors, sell the news. I expected a little bit of a sell-off with the NASDAQ and the S&P seeming to break records every single day. I just didn't expect it today. The bond market rallies like crazy, though. Check this out. The 10-year. Now, remember, when markets rally, prices up, yields come down. The 10-year falls 9 basis points, 4.19% on the 10-year. Now they're predicting it's going to go under 4%. The 2-year falls 12 basis points, down to 4.51%. The bond market, not just the last couple of months, man. The bond market's been in a bear market for since the Fed started raising rates, basically. But not today. The bond market had a really nice rally today, even though news of this Treasury auction, not good. See what think? Anyway, it's all freaking crazy. Nothing seems to work. Usually there's called logical progression. Things move along, right? This era we're in right now, that goes out the window. So the dollar today, on speculation on rate cuts, falls 50 basis points, down 50 bips today, 104.46 on the index. Okay, I guess that would be expected. I didn't expect the dollar to tank that hard in one day, especially when the rate cuts didn't happen. Just on speculation, they're going to. But you know how Forex is a big market. People got to trade. Gold and silver today rallied nicely with the dollar falling like that. Gold up $43.80, $2,415.50 for an ounce of gold. And I said it yesterday too. We're going to see $2,500 gold soon. This certainly leads me to believe that that probably was correct. Silver rallies up 65 cents, $31.42 for an ounce of silver. Nice solid number. Let's create some space between where we are, the price today, and that $30 resistance number or support number. Good day for gold and silver, guys. People on this chat, most of the people that watch this show, well, we know a lot of those people are holding gold, silver, platinum, and all kind of metals, even Bitcoin and crypto. Good day for those people on precious metals, at least. Crypto, not so much. Oil today, the bane of my existence, rallies up 52 cents, $82.62. Rally on oil because of a rate cut. The report on demand was shit. The demand for oil is falling. I've been trying to tell you guys, the price is inflated right now. This is a big kind of OPEC, oil producers in the U.S. and everybody else doing what they got to do to try to keep prices high. Should not be here, guys. The demand for oil is not there. The supply is. You're going to see oil prices come down. Believe it. Bitcoin today falls $103 after rallying early in the day. I thought Bitcoin might rally with the stock with the Dow, which it's kind of been following along with for a while. Not so much. Follows the Nasdaq and the S&P down today, down $103, sitting at 57,380. So really a non-event for Bitcoin today. All right, so let's talk about CPI. The report comes out. It shows inflation fell year over year last month, 3%. It's down from 3.3% and better than the 3.1% everybody expected, which was a number everybody was going to celebrate anyway. But 3% was like, wow, pop the champagne, light the cigars, guys. Core inflation sits at 3.3%. Smallest increase in core number since April of 2021. Top line number actually fell 0.1%. Core only rose 0.1%. So these numbers look pretty good for Powell, opening the door to at least start discussing rate cuts. Personally, I've told you the story of how I feel about those. I think they got a couple of big obstacles in the way, right? Now, you still got the number 50% above their target, guys. The target is 2. The number sits at 3. That's a pretty, I mean, let's face it. That last 1% is going to be the hardest 1% to get, right? So that tells me I think we're further away than most people think. The bad news in the report was housing prices, housing costs, which rose 5.2% year over year. Now, the market reacted like we hit the 2%. Talk of September rate cuts was, I mean, that's all you could see in any kind of financial news today. Different takes on the rate cuts coming. So I guess what, guys? We're actually going to see the unicorn, the soft landing. I got my doubts, guys. I really do. Number one, here's the 2 obstacles I see in the way of the Fed cutting rates as soon as even September. Now, I could be wrong, but I doubt it, okay? You got 2 big obstacles in the way. First obstacle is the presidential election. And I've made this case a million times, so I won't go into a ton of detail. It's just against Fed tradition to be raising or lowering interest rates during a presidential election, the 3 months of that election. September, October, November kind of thing. They don't typically raise rates. They did do that in 2008 because it was an absolute freaking emergency and the entire economy was about to go up in smoke. I can't remember another time where the Fed raised rates during the presidential election. So that's a big obstacle. And with Donald Trump being the candidate who would be hurt by the Fed cutting interest rates, a big obstacle becomes just a little bit bigger. The second obstacle is what history taught us in the 70s and 80s. Now, this is exactly the way it went when Arthur Burns was chair. They kept talking about, okay, we got the boogeyman in the closet now. It's all safe. Everything's good. But they start cutting rates. Inflation not only comes back harder than it ever was. So now they got to go back, raise rates again. As soon as they get rates near target, boom, they cut rates again, another giant spike. And what they finally had to do, the way to finally, kill the devil here, was they had to raise rates. Overnight rates were as high as 19%, basically snuffing out any transactions on credit. Basically, and we weren't as reliant on credit back then as we are today, thank God. So I don't think that's going to be an option the Fed's going to have in its toolbox, raising rates, above 10, 12, 15%. That's not going to happen. But what is going to happen is the same thing that happened with those higher rates. They're going to finally have to force a gnarly, ugly recession. Now, they're already talking about jobs being a little bit weaker than they were, and they are. We were down to what? 100,000 on jobless claims. Now we're more than double that. So we'll see. But I got to say, I got my doubts about this soft landing and these scenarios. You got politics in the way of a Fed cut. You got history in the way of a Fed cut. Now, don't get me wrong, guys. The people there, Powell and the rest of the stooges on the Federal Reserve, let's see how steeped in history they are. Let's see if they understand the risk they take by cutting rates prematurely. I think what's going to end up happening is they're not going to move and cut rates. Somebody will win, either Biden or Trump will win that election in November, and they're going to start clamoring, bang, 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 even on their acceptance speech, I'm guessing, for the Fed to start cutting rates to revive what should be at that point an economy kind of just limping along. Now, the jobless claims came in today, and boy, guys, they really, it wasn't a great number. It was just great compared to what they were expecting, right? Now, they were expecting 236K. Okay. Last week, when the number came in, it came in at 239K. So they were expecting jobless claims to come down just a little bit. The number they got, 222K, 222,000. So they beat the estimate. They beat last month by 17,000. They beat the estimate pretty well as well. So this kind of gives a smidgen of truth to the idea that the job market is softening, but it's not so soft as to put us in threat of recession. Well, guys, let me say this. The corporate world we're living in just does not care so much about the employees that work for these companies. The first sign of recession, the first sign that they can actually get away with mass layoffs, you're going to see them come, guys. Now, the Fed's doing what they can to avoid this big unemployment crack up, but obviously, I think, and we've been saying it since the beginning, it's what the Fed needs. They need a recession. They need unemployment. They need people spending less money. As I've said a million Brazilian times on the show, guys, it's not interest rates that get rid of inflation. It's not. Interest rates, especially raising interest rates, slows down the economy. You raise rates too much, it causes a big recession. The recession stops people from spending money because they don't have it to spend. Lack of spending forces sellers to lower prices to create demand. That's how it works. That's how it's going to work this time. Let's see, though, does the Fed, it's going to be a fascinating few months, guys, especially the September FOMC meeting. Going to be fascinating to see. Will the Fed cut rates in September? I'm sticking to my guns and I'm saying they won't. Now, granted, data could change between now and then that would change my opinion of it. But as things stand right now, I'm telling you, we're going to get one rate cut. It's going to happen in December. Allstate, you see this? Remember, I was talking for a couple of days in a row about home insurance and home real estate taxes going up to the roof, destroying people who are trying to buy a house or live in a house, own a house, people being forced out of their houses, not because of interest rates, but because of property taxes, because of homeowners insurance. Listen to this. California getting smacked around pretty hard. First, you had State Farm come in, asked for a 30% increase. 30% increase. So if you're paying $2,000 a year for homeowners now in California, your homeowners are going up to $2,600. Allstate today comes in, asks for a 34% increase. You think wildfires in California are going away, guys? Do you? You think the threat for homeowners insurance is going to get less in California? I don't see it. So this now is California is already ridiculously priced. So I guess, having your homeowner, when you're paying $1 million for a 1,500 square foot house built in the 40s, a little bit extra homeowners insurance, not going to make that big of a deal. It's just amazing to me, the numbers, guys. 34% increase. And there's just nowhere for these poor customers to go. You got everybody in the state raising prices like that like crazy. Obviously, insurers having some difficulty with the wildfires and some gigantic losses they're trying to make up. Tough times, tough times, tough times. So what's going to happen is now you're seeing foreclosures start to spike in the usual spots: Texas, Florida, Nevada, Idaho, even in there, because they had a big surge of people move there during the pandemic. Now, don't get me wrong, it's still not to a scary number yet. It's not something that's going to be headline news, but it's just the start of the snowball rolling down the hill. Okay? And today was the interesting day in the bond market. That's why I was surprised bond yields came down as hard as they did. The U.S. government, in their insatiable appetite to continue to borrow money, had an auction today that was in big trouble, guys. $22 billion in 30-year Treasury bonds. Okay. Now, the Treasury anticipated huge demand for these, right? Because you can lock in higher interest rates on higher returns for 30 years. That's a pretty smart way to go. Buying long-term debt before they start to cut rates. Not only are you going to get a higher yield, in a lot of cases, you can sell those bonds, make capital gains on those bonds. Okay. So they were really expecting the auction today to be oversubscribed. Guess what? It wasn't. It was not. The demand was so weak that they were forced, the dealers were forced to offer a premium on the rate, on the yield, to get some sales generated. They still had to hold a number way higher than they're happy with holding. They thought that this would be a slam dunk no-brainer. Guess what? Appetite for Treasury debt waning at the same time as the supply of Treasury debt is just, it's $50 billion in the last 2 days. $50 billion in the last 2 days. And both of those auctions have had difficult times moving the supply. Bond dealers having difficulty, forced to hold more bonds than they want to. This is going to be a problem, guys, and this is something else the Fed's going to have to consider. If you got a 30-year bond at 5, just used a round number, and there's no demand for it at 5, the way you're going to get demand is make it 5 1/4, 5 1/2, not dropping it to 4 3/4, 4 1/2. So this Fed is in a pickle between the Fed, the Treasury, and the government. The demand for money is so outrageous. The U.S. government borrowing money like there's an inexhaustible supply. They're going to find out there isn't. Anyway, guys, that's it for the day. A crazy-ass day. Tomorrow we'll get the PPI numbers. Those will be interesting. They'll give us a little bit of a hint over where prices are going to be going forward. This is the wholesale number. We'll also get a University of Michigan, which is always an interesting one. A lot to talk about there. I appreciate everybody on the chat. I appreciate everybody watching this show here. Please hit the thumbs up, the like button, guys. It changes the algorithms around. For some reason, our views are down. I think I bore you guys because I kind of use the same format every day. I don't put clown noses on. I don't wear wigs or make up ridiculous nicknames for people. I don't do the weird stuff that a lot of people do. I guess this show is more, in my mind, it's supposed to be about information than it is amusement, entertainment. Anyway, hit the thumbs up, guys. We'll be back tomorrow to bring you the news you need. It's going to be a huge day. We'll wrap this week up. Until then, everybody, take care. Thanks.